Imagine waking up one morning, opening your investment account, and seeing that the market has dropped again. The headlines are negative, your retirement account is down, your friends are talking about recession risks, layoffs, and rising costs. And yet, quietly in the background, a small group of regular investors are doing something that looks almost irrational. They are buying more. Not because they are reckless, but because they recognize a signal that has appeared only a handful of times in modern financial history. The uncomfortable reality is that the last time this exact signal appeared, many ordinary people, not hedge fund managers, not Wall Street insiders, ended up becoming millionaires over the following decade. Let's talk about the actual numbers behind that moment, why it worked, and why understanding this signal matters if you're someone earning a normal income trying to build real wealth. Because if you're between 25 and 45 today, earning somewhere between $60,000 and $150,000 a year, chances are you felt financially trapped at some point. Rent rising faster than income, homes feeling less affordable, groceries, child care, insurance, all climbing. It can feel like you, doing everything right yet still falling behind. But here is something most people miss. Wealth is not built during comfortable times. It is built during uncomfortable ones. And the market signal we are talking about today tends to appear exactly when the majority of people feel the most uncertain. Let's go back to the last major example of this signal appearing clearly. The year was 2009. The global financial system had just gone through one of the worst crises since the Great Depression. Between October 2007 and March 2009, the S&P 500 fell roughly 57%. A portfolio worth $100,000 at the peak was suddenly worth about $43,000. Millions of people watched retirement accounts shrink. Unemployment rose above 10%. Housing prices collapsed. Confidence was near zero. In surveys taken during early 2009, nearly half of Americans believed the stock market would continue falling for years. And yet something interesting happened in the numbers. Valuations dropped to historically cheap levels. The price-to-earnings ratio of the S&P 500 fell near 13, well below the long-term average of around 16 to 18. Dividend yields rose above 3%. Companies that had been trading at 30 times earnings just a few years earlier were suddenly available at half that valuation. In simple terms, investors were being offered ownership in profitable companies at prices the market rarely offered. At the same time, another signal appeared. Massive liquidity entered the system. Central banks began lowering interest rates and injecting money into the economy to stabilize financial markets. Mortgage rates started falling. Corporate borrowing costs dropped. In the short term, the economy still looked fragile. But in the long term, the ingredients for recovery were quietly being set in motion. Now here is where the story gets interesting for regular people. Imagine a 30-year-old investor in 2009 with a modest salary of $70,000 a year. Nothing extraordinary, no hedge fund connections. Just someone consistently investing through a retirement account. If that person simply invested $500 per month into a broad index fund tracking the S&P 500 starting in March 2009 and continued for the next 15 years, the math becomes surprisingly powerful. $500 a month equals $6,000 per year. Over 15 years, that is $90,000 invested. But the market did not stay depressed. From the bottom in 2009 through 2004, the S&P 500 has delivered an average annual return of roughly 13%, including dividends. When you apply that return to consistent contributions, the portfolio would grow to roughly $260,000. That is nearly triple the money invested, and that is just one account. Now, let us expand the example. Many investors were contributing not just to taxable brokerage accounts, but also to retirement plans, like household 1Ks with employer matches. Suppose that same investor contributed $10,000 per year into a 1K, received a 4% employer match worth about $2,800 annually, and invested consistently during the same recovery period. Over 15 years, total contributions would equal around $192,000. With the same 13% annual return, that account alone could grow to more than $500,000. Combine that with other investments in home equity and suddenly the path to $1 million net worth becomes far more realistic than it first appears. Not overnight, not through speculation, but through mathematics. This is the part that often surprises people. The individuals who benefited most during that period were not the ones trying to perfectly time the bottom. They were the ones who simply stayed invested while everyone else was afraid. The market did not recover in a straight line. In fact, between 2010 and 2012, there were several corrections of 10 to 20% that scared investors again. But those who kept contributing month after month were effectively buying shares at discounted prices. Think of it like purchasing pieces of businesses on sale. If a company earning $5 per share normally trades for $100 but suddenly sells for $60 during a downturn, the long-term investor is acquiring future earnings at a much cheaper cost over time. When prices recover, those discounted purchases compound dramatically. The deeper reason this signal matters comes down to how markets function over long periods. Markets move in cycles of fear and confidence. During expansions, optimism pushes prices higher. Eventually, valuations stretch too far, corrections happen, and fear takes over. That fear creates the next opportunity. When prices drop faster than the underlying earnings power of companies, the market becomes undervalued. Historically, those undervalued periods have been the starting points for the strongest wealth-building decades. After the 2009 bottom, the S&P 500 rose more than 700% over the next 15 years when dividends are included. A $10,000 investment near the bottom eventually grew to more than $80,000. That kind of growth is not typical every decade, but it shows what happens when investors buy during moments when the market is pricing in too much pessimism. For many people watching today, the bigger frustration is that life expenses make investing feel difficult. Rent in many U.S. cities increased 40 to 60% over the past decade. Groceries rose roughly 30 to 40% since 2001. Childcare in some states costs over $15,000 per year. When income is $100,000 but expenses consume $90,000, there is very little margin in your budget. And when margin disappears, investing becomes emotionally harder. This is where the psychology of market signals becomes important. Because the exact moments when investing feels the least comfortable often turn out to be the moments with the greatest long-term payoff. The signal we are talking about today is not a secret indicator hidden in complicated charts. It's something much simpler. It appears when fear is high, valuations are lower than historical averages, and long-term economic productivity is still intact. In other words, the economy looks messy in the short term, but the engine of innovation and business growth is still running underneath the surface. Understanding that difference between short-term chaos and long-term growth is one of the most valuable financial skills an investor can develop. And last time this signal appeared clearly, those who recognized it and kept investing quietly positioned themselves for one of the largest wealth-building periods in modern market history. To understand why this signal creates so many future millionaires, you have to step back and look at how wealth actually compounds over time. Most people imagine wealth appearing suddenly through a big breakthrough investment or a lucky stock pick. But when you look at the actual numbers behind many millionaire portfolios, the pattern is much more boring and much more logical. Wealth tends to grow slowly at first, then accelerate dramatically once compounding gains momentum. Let us do the math in simple terms. If someone invests $800 per month starting at age 30, that equals $9,600 per year. Over 10 years, they would contribute $96,000 of their own money. If that portfolio grows at an average of 8% annually, which is close to the long-term historical return of the U.S. stock market after inflation, the portfolio would reach about $140,000. That's progress, but it still feels far away from real wealth. However, the next 10 years tell a very different story. If the same investor continues contributing the same $800 per month, and the portfolio keeps compounding at 8%, the total value after 20 years jumps to around $460,000. Now the growth starts accelerating. Over the next 10 years, assuming the same contributions and return, the portfolio grows to more than $1 million. Notice something important here. In the first decade, the portfolio grew by about $40,000 beyond contributions. In the third decade, it grows by more than $500,000. That is the power of compounding. The early years feel slow and sometimes discouraging, but once the base becomes large enough, the growth becomes explosive without requiring larger contributions. This is exactly why downturn signals matter so much. When markets decline 30, 40, or even 50%, investors who keep buying are effectively purchasing the same future earnings at much cheaper prices. Imagine two investors starting at the same time with the same $800 monthly contribution. Investor A invests during expensive market conditions where valuations are high and future returns average 6% annually. Investor B invests during a depressed market period where valuations are lower and future returns average 10% annually. Over 30 years, investor might end up with around $800,000. Investor B, benefiting from stronger returns during the early accumulation phase, could end up with around $1.7 million. That difference did not come from luck or intelligence. It came from starting during a cheaper market cycle. Another way to understand this signal is through valuation ratios. One of the most commonly discussed measures is the price-to-earnings ratio, often called the PE ratio. This simply measures how much investors are paying for each dollar of corporate earnings. Historically, when the S&P 500 trades above 25 times earnings, future returns over the following decade tend to be lower. When it falls closer to 15 times earnings or below, future returns historically improve. This does not guarantee anything in the short term, but over long periods, the relationship has appeared again and again. After the 2008 financial crisis, valuations dropped dramatically. Investors buying during that period were essentially buying corporate profits at a discount. As the economy recovered and profits grew, those discounted purchases multiplied in value. But the story does not end with valuation. The second force behind this signal is liquidity. When central banks reduce interest rates and financial conditions become easier, money begins flowing back into businesses, markets, and innovation. Lower borrowing costs allow companies to invest in growth, expand operations, hire workers, and develop new products. Over time, those improvements show up in rising corporate earnings. Rising earnings eventually lead to higher stock prices because investors are willing to pay more for companies generating stronger profits. For long-term investors, this environment can create a powerful combination: low entry prices followed by years of economic expansion. Now let's bring this back to everyday investors today. Many people watching this video are earning solid incomes, yet still feel financially squeezed. A household bringing in $120,000 per year might spend $30,000 on housing, $15,000 on childcare, $12,000 on groceries, $10,000 on insurance and healthcare, and another $20,000 across transportation, taxes, and everyday costs. Suddenly, $90,000 is gone before serious investing even begins. When you look at those actual numbers, it's easy to understand why people feel financially trapped. You are not failing. The system is simply more expensive than it used to be. But even within tight budgets, the concept of margin still matters. Margin in your budget is the small gap between income and expenses that allows investing to happen consistently. Sometimes that margin is only $500 per month. Sometimes it is $1,000. What matters is not the size at the beginning, but the consistency over time. Here is an example. A couple earning a combined income of $110,000 decides to invest $700 per month into a low-cost index fund. That equals $8,400 per year. If they increase contributions by just 3% annually as their income grows, and the portfolio earns an average return of 8%. After 25 years, the portfolio could reach around $900,000. Add a workplace retirement plan with employer matching, and the combined value could cross $1.3 million. None of this requires predicting the perfect moment to buy or sell. It simply requires participating in the market while compounding works quietly in the background. This is where the current conversation around market signals becomes interesting again. Periods of volatility, economic anxiety, and negative headlines often discourage investors from participating. Yet, historically, those same environments have been the starting point for strong future returns. During the early months of 2009, confidence was extremely low. During the pandemic crash in 2001, fear returned briefly again. In both cases, markets eventually recovered and reached new highs because the underlying economy continued producing innovation, technology, productivity, and corporate growth. None of this means the market moves upward every year. Corrections are normal. In fact, the stock market experiences a 10% decline on average roughly once every 18 months. Larger bear markets of 20% or more appear every 5 to 7 years. These declines are uncomfortable, but they are also the mechanism that resets valuations and creates the next opportunity for long-term investors. The signal we are discussing tends to appear during those uncomfortable resets. For someone in their 30s today, the goal is not predicting the next 6 months. The real goal is owning productive assets for the next 30 years. If someone invests consistently from age 35 to 65, that is 3 full decades of compounding. Even moderate returns during that period can transform ordinary savings into financial independence. A portfolio that reaches $1 million and produces a 4% withdrawal rate could generate $40,000 per year in retirement income. Combine that with Social Security or other savings, and suddenly the idea of a stress-free retirement becomes realistic. So the deeper message behind this market signal is not about chasing the next boom. It is about recognizing when fear has temporarily pushed prices below long-term value. The last time that happened in a major way, patient investors quietly accumulated assets while others stayed on the sidelines. Over the following decade, many of those investors crossed the $1 million mark without doing anything extraordinary. They simply respected the mathematics of compounding, maintained margin in their budgets, and stayed invested long enough for the system to work in their favor. If you are someone feeling financially stuck today, remember this. Building wealth rarely feels dramatic while it is happening. Most of the time, it looks like boring monthly contributions, ignored headlines, and patience during uncomfortable market cycles. But history shows that those quiet decisions repeated consistently over decades are exactly how ordinary investors end up achieving the kind of financial freedom that once seemed impossible.